In today's uncertain economy, the retail sector is undergoing a seismic transformation. Struggling against plummeting sales, soaring inflation, and mounting debts, major big-box retailers are on the brink of collapse. The stability they once enjoyed has eroded, thanks to shrinking profit margins and escalating expenses. Join us in this video as we uncover the stories of these iconic retail giants facing an unprecedented crisis. From their past successes to their current struggles, we'll explore the factors driving their downfall. Will these household names weather the storm? Or is this the end of an era? Ready for an in-depth look at the unraveling retail landscape and a closer examination of the challenges these retailers face. As the tides of change continue to reshape the industry, don't miss this video on 15 big-box retailers collapsing before our eyes. Let's get started. 1. Staples. Staples, a renowned office superstore, has been on a downward trajectory for nearly a decade, culminating in its struggles during the pandemic. The company's woes began with the closure of 225 locations in 2014, resulting in substantial revenue losses. When the pandemic hit in 2020, Staples was already grappling with a significant debt load of $5.3 billion against modest revenues of $1.5 billion. The shift towards remote work further hindered its recovery, forcing the closure of 200 underperforming stores and job cuts. Inflation and online giants like Amazon intensified the challenges, leading to a 6.7% sales drop in the first quarter of 2023. Staples' future remains uncertain, as its existing liabilities and limited differentiation in a digital age could potentially lead to its collapse in the midst of the ongoing economic recession. 2. Giant Eagle. Giant Eagle, a food retailer, is grappling with the need to close and restructure stores to combat economic downturn impacts. Consumer shifts and rising costs have prompted closures and operational changes to avoid financial collapse. With thin profit margins and inflation affecting prices, the company faces challenges in maintaining profitability amidst changing consumer behavior and economic instability. 3. Piggly Wiggly, an iconic self-service food retailer, is facing severe challenges stemming from revenue losses, high operational costs, and an outdated business model. Lack of effective delivery and online presence has hindered its growth, causing a decline in customer engagement dynamics. 4. Urban Outfitters. Urban Outfitters, a retail chain catering to a younger demographic, is battling inflation and operational errors. Price hikes and a shift in consumer spending have led to a 9% sales decline in brick-and-mortar stores. The absence of a CEO further complicates matters. In a highly competitive landscape, the retailer must swiftly address pricing strategies and operational challenges to rekindle growth and resonate with its target audience. 5. Home Depot. As the largest home improvement chain, Home Depot is grappling with challenges arising from a stagnant economy. Declining sales, disappointing profits, and a 4.5% drop in same-store sales during its latest quarter underscore the challenges. The housing market slowdown and reduced spending on home projects amid high interest rates are impacting Home Depot's revenue. The chain's performance is closely tied to the housing market's health, making it vulnerable to economic fluctuations and underscoring the need for strategic adjustments to weather the storm. 6. David's Bridal. A prominent wedding apparel brand filed for bankruptcy in 2023, signaling potential demise. The company cited inflation pressures and changes in the wedding industry as key factors in its decline. With over 9,000 job cuts and restructuring efforts, David's Bridal struggles to re-establish its foothold. The bleak outlook is compounded by a 22% sales decrease in the last quarter, making it challenging to find a buyer amidst economic uncertainty. CEO James Markham expressed that without intervention, the brand might face complete liquidation by the year's end. Given its sales struggles and the reluctance of potential buyers during a recession, David's Bridal's survival hinges on a narrow thread, mirroring its customers' challenges in wedding planning amid economic turmoil. 7. Walgreens. The 122-year legacy of Walgreens is under threat as the pharmacy giant grapples with mounting losses and store closures. Announcing the shutdown of 450 locations in 2023, the company's shares plummeted to an 11-year low due to profit forecasts slashed by executives. Faced with weak sales growth and a 17% drop in stock value since January, Walgreens' colossal debt and liabilities are casting doubts on its financial viability. The company's ability to meet obligations is in question, and if it fails, bankruptcy looms, given its $13 billion debt load. Struggling with limited cash reserves, Walgreens faces the tough task of navigating through its debt crisis during a recession, where consumer health and economic health are intertwined. 8. Rite Aid. Rite Aid, a competitor in the pharmacy sector, is also grappling with challenges that threaten its existence. The company's struggles are deeply rooted, with limited scale and profitability compared to its rivals. After selling off thousands of stores in 2018, the company's position has worsened. Persistent foot traffic decline and a 41% stock drop over the year have exposed Rite Aid's vulnerability. Amidst market changes and fierce competition, the brand's prospects for a turnaround seem limited, especially as the economic downturn further accelerates its decline. 9. Victoria's Secret. Despite efforts to revamp post-bankruptcy, Victoria's Secret's woes persist. The brand's sales have plummeted by 9% and 7% in consecutive quarters, as higher-priced products deter price-conscious consumers. Over 300 store closures in 3 years, coupled with credit constraints, indicate a shaky future. Amid rising competition and deteriorating economic conditions, Victoria's Secret faces challenges in retaining its customer base and profitability. With a second bankruptcy on the horizon, the brand's ability to navigate economic turbulence and reshape its image is pivotal for its survival. 10. Foot Locker. Foot Locker, a shoe retailer, is on the brink of bankruptcy due to a combination of factors. Falling foot traffic led the company to consider shutting 400 U.S. retail stores. Declines in sales and net income, attributed to tough macroeconomic conditions, have strained the company's financials. Foot Locker's struggles are magnified by a 27% stock drop in a single day. Urgent reorganization efforts are necessary to tackle inventory challenges, adapt to shifting consumer behaviors, and remain resilient in the face of a recession. 11. Old Navy, a prominent apparel brand, is struggling with sales declines and revenue losses due to inflation impacting consumer spending. The company's failure to capitalize on trends and delayed rollouts have caused a significant decline in profitability. The absence of a CEO adds to its instability. Swift action is necessary to address consumer preferences, enhance product offerings, and revamp the brand's identity to remain relevant and competitive. 12. 7-Eleven. 7-Eleven is facing internal strife with franchisees, and its future is uncertain. Lawsuits and conflicts regarding operational hours and wages are disrupting the brand's traditional model. The parent company's decision to sell the chain raises questions about its longevity. With ongoing disputes and changing consumer habits, 7-Eleven's path ahead hinges on resolving internal issues and adapting to evolving retail landscapes. 13. Lowe's, a home improvement giant, is grappling with weak demand for home improvement products amid rising living costs. Consumer spending on such projects is dwindling due to economic constraints. The company's fortunes are closely tied to the housing market, making its future uncertain as it navigates the impact of changing consumer behavior and economic fluctuations. 14. Kohl's. Kohl's, a retail chain, is facing a decline in sales and profitability, partially attributed to frequent price hikes over recent years. The company's financial position is strained, with operating costs outweighing revenue. Economic challenges and increased competition have put pressure on Kohl's performance, necessitating a comprehensive re-evaluation of pricing strategies and operational efficiency to secure its future in the retail landscape. 15. Marshall's, a discount store, is experiencing challenges in differentiation and pricing. Its sales remain stagnant, with a struggle to attract customers. The decline in foot traffic and competition from other discount retailers are impacting its growth. To revitalize its position, Marshalls needs to enhance its value proposition, adjust pricing strategies, and explore ways to entice shoppers in an ever-evolving retail environment. The landscape of big-box retailers is undergoing a significant transformation amidst the toughest economic conditions in recent memory. The convergence of factors such as inflation, rising costs, changing consumer behaviors, and internal operational challenges has led to the collapse and decline of several iconic brands. Staples, David's Bridal, Walgreens, Rite Aid, Victoria's Secret, Foot Locker, Home Depot, and others are grappling with various hurdles, from debt burdens to pricing missteps and outdated business models. These struggles are further intensified by the ongoing economic downturn, prompting store closures, revenue losses, and job cuts. As the retail industry navigates these challenges, adaptation and innovation become imperative for survival. Retailers must not only reassess their pricing strategies and operational efficiencies, but also redefine their value propositions and engage with evolving consumer preferences. Only by embracing change and seizing opportunities can retailers hope to weather the storm and emerge stronger in the dynamic retail landscape of the future.